Okay, first off, no surprise, taxes went up. We added a new top rate, 39.6%. Capital gains rates and dividend rates went up. If you were here for the talk on the Patient Protection and Affordable Care Act, you may have heard about some of those taxes going up. Obamacare taxes were added on top of that. Again, no surprise but they did fix the alternative minimum tax. So let's kind of dig into this and see what we're talking about. The original Bush tax rates are going to lapse. We talked about that. The Bush tax rates had 6 actual different rates. Prior to Bush tax rates, there were only 5 rates. But the 5 rates were higher, and the brackets, that's the amount of income subject to each rate, were different. As a matter of fact, there was something called the marriage penalty in there, where they said 2 people who were single paid less tax on the same income than 2 people who were married, and they fixed that in the Bush tax rates for the first 2 tax rates, the 10% and the 15%, where if you're married or you're single, you'd pay the same tax. So we did get an increase, but we only got an increase of 1 rate. They added 39.6 on top instead of blowing out all the old rates and putting back in the ones prior to Bush. So that's actually not too bad. It means that everybody paying tax will still pay the 10% rate and the 15% rate and all the other rates up to they get to the point where it's 39.6, and then they'll pay that on the rest of their tax. So although it's not terrific, it could have been a lot worse. Now that cutoff is $450,000 for married filing joint or $400,000 for single. So if your income is below that, you're only going to pay the original rates that were in effect last year. If your income is above that, you're going to pay 39.6 and above that. And obviously California has their own tax rates beyond our scope here, but that's also going to apply to people. Let's go, and I did note down at the bottom, all these changes are permanent. No more, when Bush tax rates came in, they were 10-year tax rates. They lapsed or were threatened to lapse, and that created a lot of the confusion and controversy, made it a difficult environment for businesses to make decisions. Now they're permanent. Capital gains, what happened here? Not all bad news either. You may recall we did talk about before about them going to 20%, but not for everybody and not on all income. If your tax rate, the percent of income that you pay, is in the 10% or 15% only, you pay 0% dividend rate. So that's still there. In addition to that, if you're above that, in the 25% bracket or above that, but below $450,000, you pay 15%. But you do also pay the Obamacare tax if your taxable income is $250,000 or higher. Does this kind of sound like Alice in Wonderland down the rabbit hole? It's this way, it's that way. It kind of is that way with these rules. So you will pay either 15% if you're at or above 25% tax rate but below $250,000 taxable, or you'll pay 18.8. If your income is $450,000 or higher, married filing joint, you actually pay 23.8 on capital gains. That's the 20% in this new law and 3.8 from Obamacare. What happened with dividends? You may recall, if you were here last time, we talked about dividends could potentially have gone all the way up to 43.8, almost tripling the 15% that they were at. That was kind of a nightmare to face. I think that a lot of people were wondering what was going to happen to them. Well, we got the same rules as the capital gains rates. These are exactly the same information. 10% or 15% bracket, you pay 0% on your dividends. Going to really help out those people who are retired. If you're above 15% but below $450,000, you're either going to pay 15% on your dividends or you're going to pay 18.8 if you're above $250,000. If you're above $450,000, you pay 23.8%. But when we were thinking we were facing 43.8, 23.8 is not bad. Not bad at all. This is an unpleasant surprise. Itemized deductions, what happened here? This used to be in the law and it's come back. What it is it's a cap or a limit on your itemized deductions that you can deduct on your tax return and a limit on the personal exemptions that you get. This used to be in the law several years ago. It's now back in the law. Basically, if your adjusted gross income for a married filing joint is $300,000 or more, the amount over that times 3% is subtracted from your itemized deductions. So for someone who is $350,000, they're not going to lose much. For someone with $1 million of taxable income, they could lose a lot of itemized deductions. You can lose up to 80% of your itemized deductions. Or if you only take the standard deduction, you can lose up to 80% of the standard deduction. So this is an unfortunate rule, and it's one we're going to have to live with. This was actually one of the things they were talking about before they were trying to negotiate between this kind of a tax increase and a rate increase, and we actually wound up with both. We get a personal exemption for ourselves, for our spouses, for our dependents. It's around $3,000 or so. They are phased out, again, if your adjusted gross income married filing joint is above $300,000. And as a matter of fact, for married filing joint, it's phased out completely if your adjusted gross income is $450,000 or higher. 422,000. 422,500. So a lot of people are going to lose their personal exemptions. They're going to go away from their tax returns. It's just something we're going to have to face. It's a complex calculation. Basically, you have to divide it by 2,500 and multiply times 2%. Again, it takes a computer to calculate it, not something you're expected to do in your head. But if your income is above that $422,000 level, you know you're not getting your personal exemptions. And for a family of four, that might be a $14,000 or $15,000 deduction that's gone.